Ladies and gentlemen, on behalf of the SBI, I extend warm welcome to all the media representatives who have virtually joined. We are pleased to announce the SBI financial and results for Q4 and annual results for financial year 23. Now I welcome to our Chairman Sri Dinesh Khara, Managing Director Sri C.S. Shetty, Sri Swaminathan J, Sri Ashwani Kumar Tiwari, and Sri Alok Kumar Chaudhary to the conference. I also welcome to the other top executives present in the boardroom or joining virtually. We appreciate your presence here. Now I will begin this media briefing. To do this honor, I invite our chairman Sri Dinesh Khara to address the media and shed the light on the bank's financial performance for Q4 and financial year 23. After which we will open the floor for question and answers. Sir, over to you, sir.
Thank you. Thank you very much. Very good afternoon to all of you. Thank you for joining this press meet post announcement of our financial year 23 annual results. The global economy is, of course, passing through certain uncertain times with the cumulative effect of adverse shocks of the past 3 years, most notably the COVID-19 pandemic and the geopolitical situation in Ukraine, manifesting in unforeseen situations. Spurred by the pent-up demand, lingering supply disruptions, and commodity price spikes, inflation reached multi-decadal high last year in many economies, nudging those central banks to tighten aggressively to bring it back towards their target and keep inflation expectations anchored. As a result of all this, the baseline forecast for global growth is to fall from 3.4% in 2022 to 2.8% in 2023 and then rebound to 3% in 2024. However, in this backdrop, India remains resilient to many of the adverse external environment owing to large domestic market. Despite all the headwinds, India's GDP in financial year 23 is estimated to grow at 7%, driven by investment and private consumption. Going ahead, the economic activity would be supported by improving rural demand too. The government thrust on infrastructure spending, a revival in corporate investment, healthy bank credit, and moderating commodity prices will also go a long way in terms of supporting the Indian economy. Despite the increase in interest rate and its transmission, credit growth has continued to grow in double digit and has been broad-based across sectors in the financial year 23. During financial year 23, all scheduled commercial banks credit grew by 15% YOY, as against 9.6% YOY in financial year 22, while aggregate deposit of all scheduled commercial bank grew by 9.6% YOY compared to last year's growth of 8.9% YOY. In the Union Budget for financial year 24, several steps have been taken to push up the capital investment in the country, which will eventually boost the credit demand in the country. We expect credit growth to continue in financial year 24 also, although some moderation might happen here and there. In the above economic backdrop, let me now give some color on the bank's number for financial year 23 as well as for the Q4 of financial year 23. I'm pleased to announce that for the third quarter in running, we have posted our highest ever quarterly profit of 16,695 crores. For the full year, our net profit has crossed the landmark number of rupees 50,000 crore, which is the highest ever by any bank in India. Net profit for financial year 23 increased by 58.58% on a YOY basis to 50,232 crores, while operating profit at 83,713 crores increased by 11.18%. ROA of the bank for the year improved by 29 basis points on YOY basis to 0.96% and ROE improved by 551 basis points to 19.43%. For the quarter 4 of the financial year 23, net profit stands at 16,695 crores, which is higher by 17.52% sequentially and 83.18% on a YOY basis. Most other core profitability metrics have also improved over previous year as well as sequentially. Net interest income for the year increased by 19.99% YOY on the back of improvement in yields and continued credit offtake. Domestic NIM also improved by 22 basis points YOY. Non-interest income declined by 9.73% YOY, mainly due to the MTM losses which we had booked in the first quarter. It was to the tune of about 7,000 crore. Other than that, our core income streams, that is fee-based income, have remained intact and have improved by 6.84% YOY basis. Operating expenses increased by 13.68% YOY as we have started building provision for the wage revision, which has fallen due from November 2022. There is some increase in overhead expenses, mainly coming through higher tech-related expenses like expenses on IT development, mobile banking, ATM, etc. And also the higher DICGC premium because of the growth in deposit. On the business front, credit growth has been robust across all the segments. Domestic advances grew by 15.38% YOY, headlined by retail personal advances, which grew by 17.64% YOY, and corporate segment witnessed a growth of 12.52% YOY. SME and agri segment have also witnessed a healthy double-digit growth at 17.59% and 13.31% YOY respectively. Domestic deposits grew by 8.50% YOY, driven by growth in savings bank deposits and term deposits. Our foreign offices have continued to perform well with good growth in advances as well as deposits. With respect to asset quality, our gross NPA ratio has come down by 119 basis points YOY and stands at 2.78%, which is the lowest level in more than 10 years. Our net NPA ratio has also declined by 35 basis points and stands at 0.67%. Slippage ratio for the year stands at 0.65%. The consistently improving asset quality is also reflected in our credit cost, which is at 32 basis points for the year, is down by 23 basis points on a YOY basis. We have a well-provided stress book with PCR showing improvement by 135 basis points at 76.39%. PCR including OCA improved by 170 basis points and is at 91.91%. On the restructuring front, our total exposure under COVID resolution plan 1 and 2 stands at 24,302 crores as at the end of quarter 4 of financial year 23. The restructuring book has behaved very well and is within the expected numbers. And even if we reckon SMA 1 and SMA 2, the book is actually shaping up much better as compared to what we normally observe in the SME subsegment. We are holding sufficient additional provision against these restructured accounts. The bank remains very well capitalized and we have sufficient headroom to take care of the normal business growth requirement. Our capital adequacy ratio has improved by 85 basis points on a YOY basis and stands at 14.68%. CET1 ratio has also improved by 33 basis points and is now at 10.27%. And both the ratios are well above the regulatory requirements. Digital continues to be an important customer acquisition engine for the bank across assets as well as liability products. During the year, we have sourced 64% of the savings bank accounts and 35% of the retail asset accounts digitally through YONO. We have embarked upon a journey of creating digital bank of choice within the bank as we have moved on to YONO 2.0 for further improvement in our offerings. Our subsidiaries have also consistently performed well and continue to create significant value for all the stakeholders and, most importantly, for the customers. Most of our subsidiaries are the leaders in their respective segment. We will continue to nurture these subsidiaries and see them creating value for their own shareholders as well as the shareholders of SBI. Before I conclude, I would like to thank you all for your continuous support to the bank. We consider it as a privilege to be able to contribute towards the growth of our economy. We remain committed to rewarding your trust in us with superior sustainable returns over the long term. I wish everyone here the very best of health and happiness. Floor is now open for your questions. Thank you.
Thank you so much, sir. Now we move to the media Q&A. I urge the media to raise their hands and unmute themselves when called upon. We request you to follow the format and restrict yourself to 2 questions each related to the results. First up, we have Ritu Singh from CNBC TV18. Ritu, please go ahead.
We are unable to hear you, Ritu.
Okay, Mr. Khara, if you can hear me.
Yeah, please go ahead.
Sir, the asset quality, of course, has seen a significant improvement year on year. What we wanted to understand is, in terms of provisioning, what is the thinking? For your NPA provisions, you've almost halved them in the quarter. But with the expected credit loss provisioning expected to kick in the next couple of years, what have you factored in terms of what you would require? Is there an internal assessment? And have you started to make any provisions for that? One. Secondly, also, sir, in terms of your slippages, from 25,000 crores in FY22, now it's down to about 18,400 for the year. Could you guys guide us as to what you're seeing in the coming year as well? The fresh slippages have come down significantly. Is that trend going to continue to play out? And as far as demand for credit is concerned, yes, it's been in double digits for the year. Interest rates have also peaked. Now they're expected to come down. What's your sense? What's in the pipeline? Where is the demand coming from? Are corporates utilizing their credit lines? If you could give us some guidance there as well.
I think one question itself is quite a heavy questions. Multiple questions in one question. So you have taken the full advantage of the clause one question. Anyhow, I'll start with the first one, which you have in your mind is something which is very heavy on your mind, is relating to expected credit loss. Well, of course, first and foremost, this is just a concept paper which has been introduced by RBI, and they have not yet formed up their views. And even if they have very clearly indicated in that concept paper also, even if it gets introduced, it will be spread over a period of 5 years. Now, let me share with you. When it comes to the ECL, it essentially means that the provision would be made based upon the expected credit loss. And expected credit loss is a probability of, one is a loss given default, LGD, and also the probability of default. So which is nothing but a reflection of the underwriting standards, and also at the same time, how the book has been. Herein, I would like to draw your attention to the fact that our corporate book is provided to the extent of 98%. And when it comes to our retail component, which is almost as high as about 42, pure play retail is about 42%. There our NPA, gross NPA ratio is somewhere in the range of 0.6. So one, I would like to say that the loss given default as it is low, and even
SEBI has made investing for your children in mutual funds a lot simpler. You'll no longer have to open a bank account for your child first. A recent circular by the capital markets regulator allows parents to directly invest in a mutual fund of a minor. The new rule will be effective 15th of June. A bank account will only be needed when a fund matures. This maturity amount can be transferred if the account to the account of the minor. That's the condition, that it can only be transferred in that case. Money Today editor Tina Jain Kaushal joining us to explain some of these tweaks. Tina, why has the rule been changed and how is it going to help?
Starting a mutual fund for your child no longer requires the cumbersome process of opening a bank account in their name. This is because, according to the recent circular released by the SEBI last week, investment can now also be made from the bank account of the parent or legal guardian